Welcome back to Wook Capital Management's weekly Wook in Review. I'm Managing Director Rod Alsman. This is our 44th edition of our weekly broadcast of major market news and events of the preceding week. We're going to have a little shorter, probably, version this week. It's about 4:05 right now Eastern. I think we'll probably wrap by 5:30. Do want to get this disclaimer out of the way. Joe, I'm not going to make you read it this time. Wook Capital Management, Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual. So we got through the balance of big tech earnings this week. We got some more, as it was the beginning of the month, we got some more macroeconomic data from various PMIs, survey data, job non-farm payrolls out this morning. So kind of go through the prepared material that, again, if you haven't, if you're joining live, I have the screen share in both the what is still known as the GME DD Discord in the stages, and you can follow along in there. The recording will have, of course, audio and video. So with that said, let me plow through the prepared content. So we got Apple and Amazon earnings yesterday. Obviously, market reaction was quite different between the two of them. In terms of Apple, it closed down, must have been its worst day of the year. Because as you can see on that year-to-date stock chart, it's pretty much been a straight line up. So the stock did close down just under 5% today, which is incredible if you think about in actual dollar terms how many companies it wiped off the map in terms of value with $150 some odd billion valuation cut today. But it's still $2.86 trillion company with a 30 plus PE ratio, and it's with declining growth. So it certainly seems overvalued to me still, but of course, doesn't matter what I think. They had weak results on most of their product lines. The positive headline being that services grew and they have reached again an all-time high installed base of devices. So from a longer term shift to services revenue, mix shift, that's good for them. But and I think it was a record high also gross margin, which again is evidence of that ongoing shift from revenues from lower margin hardware, phones, iPads, computers, etc., to the higher margin services. But yeah, it was a disappointing result, even though it beat expectations. Clearly, the kind of outlook worried some investors. There was another story out today. It's not a company I know well, called Fortinet, and this is another IT giant that kind of embodies, I guess, the sentiment. If you want to look forward from here, what they had to say is that many businesses have delayed orders due to uncertainty about the economy, and this is a much smaller company. 45 or so billion dollar market cap. So it's peanuts compared to Apple, but that stock closed down. It was down something like 25% today. So that negative read through spread across other cyber stocks, Palo Alto, CrowdStrike, Zscaler. They were all down as well. There you go. All of them with the current news right there at the bottom of the screen. So Raymond James analyst, quote, negative read through for the broader cyber group, given the year-to-date run, cyber up 55% year-to-date, versus NASDAQ up 33%. It's not surprising to see the breather, unquote. Yep. In extraordinary multiple expansion year to date in all of these technology companies, and now the worry about growth either coming in weaker than expected or stalling out, or at least in the case of Apple, declining, kind of highlights the disconnect between that multiple expansion and underlying earnings. So that's kind of got what happened in tech a bit today. The other story on the Amazon side, it was earlier this week. It was really interesting, talking about this kind of revamp of their entire, I don't know what this was. You linked the Whole Foods acquisition. Let me find the story from the notes about what Apple did earlier this week. Not Apple, I'm sorry, Amazon. Okay. I'm just trying to find where I put it. I thought you would have put it in the story.
Yeah, I
There it
linked
is.
it. I don't know what the link changed it to. Let's check.
Yeah, it was a completely different link. But anyways, I found it and it's up on my screen now. So yeah, this came out earlier in the week that Amazon is launching the biggest overhaul of its grocery business since the Whole Foods acquisition in 2017. So some meaningful changes. They're testing some new highly automated warehouses. They're also offering fresh food delivery for non-Prime subscribers for the first time. And they're going to merge all of their kind of e-com supermarket offerings, which ranges from that Amazon Fresh branding, of course, the Whole Foods, as well as Amazon.com, into one consolidated cart. And in line, I think, or at least that's what strategists think, with the strategy of securing a larger market share of the grocery business, which you can see from UBS at least. They currently have Amazon a bit under 5% of the US grocery market share. For my fellow Floridians, we see Publix just behind them. But of course, Walmart, Kroger kind of leading the way. So Amazon's, there's some interesting details in the story. I'm not going to go through the entire story. And if people want to talk about it at the end, I'd be happy to. I'm going to talk about how, for example, Amazon required a grocery order of around $115 to break even in 2010 on average. A decade later, that break-even point was still $90 to $100. So it's a very difficult business to get good economics in. I remember when I worked at Ryder, doing a lot of kind of digging into. There's a lot of different approaches, like mini or micro fulfillment centers that are co-located with a front of store grocery, and you kind of build the fulfillment at the same location. That way you don't have to duplicate supply chains from an inbound logistics perspective. And then obviously outbound logistics would be like your vans. There's kind of I think it's the approach that Kroger took with Ocado, which was to build these bigger automated fulfillment, grocery fulfillment kind of centers where it's not necessarily co-located with a store that customers can walk into. It's just a big fulfillment center that then has more automation built in. And then of course you have your traditional approach, as well as you're kind of just picking, think about like an Instacart, where it's just simply a software layer that's adding that. And the research that I've seen, which I have not stayed way on top of this since leaving Ryder, is that those micro fulfillment centers would offer the best kind of unit economics, which it seems like is kind of in line with what Amazon is going to try to do. So now they're going to have these redesigned stores. It'll be interesting to see. I've never been in an Amazon Fresh store. I don't have a Whole Foods near me, so I haven't seen them recently. But it'll be very interesting to see this revamp to their grocery approach. Obviously, they've done the stores where you don't have to actually check out your barcodes. You just sign into your account, and the cameras are able to gauge what's in your cart and automatically bill you when you walk out of the store. So look, Amazon's obviously been extraordinarily innovative, but it just kind of highlights to me when you see that the cost of fulfillment has barely budged for break even over that decade, that it's just still a really tough business. They haven't necessarily cracked the code on. So it'll be interesting to monitor how this kind of revamped grocery strategy plays out for Amazon. Um, so there's a part of the article kind of notes that in addition to delivery fees, Amazon Fresh tries to defray the costs of e-commerce with prices that stand about 13% higher online than in store. That's another thing that's always bothered me as a consumer is when you use these services, there's a lack of pricing transparency, and maybe they aren't straightforward with you, that they're baking in higher prices rather than actually, again, it's just a structurally higher cost fulfillment model than you as the consumer going into the store and picking and packing yourself. It's just how it how it works. Um, so yeah, we'll be interested to see what happens with Amazon on that front. But obviously, the market liked what they had to say about their outlook for the most part. What did the stock close up? 9%, something like that. 8 and a quarter. So pretty good day in a overall challenged market. So okay, that's all I have to say about Amazon and Apple and kind of tech. Some macro data. So job openings have continued to, I guess the way I would put it in terms of the labor market broadly is that year to date, the actions that we've seen in the labor market are what the Fed has hoped to see for achieving that goal of the soft landing. Job openings continuing to fall, the ratio of openings to unemployed continuing to fall, but not falling apart. Right? You had the non-farm payrolls report this morning, a little weaker than expected, but again, you're still adding a little under 200,000 jobs. You're still seeing in terms of initial jobless claims, pretty muted level. So even though you're seeing, as we talked about last week, things like the employment cost index continuing to kind of trend down. So it's definitely more affirmation, and kind of one of my preferred newsletters is Wall Street Journal's Real Time Economics, and in there they put one out for every NFP week, any month, excuse me, where they can have quotes from various economists, and I think that's what the consensus is at this point. And that goes back to the market. What is the market pricing? And the market is now pricing, I think, pretty resoundingly this notion that inflation is getting under control, labor tightness is loosening at a modest clip in line with what the Fed would hope to see. So here's a Citigroup economist quote: "The jobs numbers are seemingly cooperating with the Goldilocks narrative, up a solid 187K in July, but much slower than the 300K pace that prevailed earlier this year." From Wells Fargo, quote, "The labor market is only slowly coming back into balance, which is likely to keep the Fed guarded in its optimism about how quickly inflation can fade on a sustained basis." So I do think that is, in aggregate, the Fed would be biased to err on the side of moderate incremental tightening if needed. And I say if, because I do think if this data continue to come in this way, which look, there's going to be some noise in kind of inflationary data from some base effects in the coming months. But nonetheless, I think it's still in line with what is priced into the market, that base case being, and we're seeing, right, capitulation by many of those who are of the view that a recession was imminent or forthcoming. You talked about last week, I think too, right? You had the Morgan Stanley, Mike Wilson, you had Piper Sandler, kind of everyone throwing in the towel on their notion that indices would be lower and now pointing to higher. And we had on Tuesday, of course, we did our latest Wook book club where we talked about Mastering the Market Cycle by Howard Marks. And I'm not saying that this is a bubble or the top by any stretch. I'm just noting that when people capitulate, that probably means we're closer to the end than the beginning of this maybe round of the cycle, if you will. A lot of capitulation by those who were bearish, and now kind of price has forced them to react. So we'll see how it all plays out. But it's definitely good that labor is cooling, wage growth moderating, but on net, I agree that it's still a little too hot for the Fed's liking. So we'll see how that continues. And then there was one other good data point this week, which is a noisy one, but was the quarterly productivity report. So it jumped by the most since 2020 in the second quarter. So a 3.7% annual rate after it had declined in the first 3 months of the year. So it's been really choppy, but all else equal, higher productivity helps curb inflationary impacts of higher wages and other costs. So, you know, good news again if you're hoping for this soft landing narrative and for inflation getting back under control without the need to force the real economy into a recession. So, okay, and then let's see. I'm gonna I'm gonna just talk about two last things in the prepared stuff, and then anyone who wants to come up as a speaker and chat, please feel free to request. Talk about any of the things that we've discussed or any other items on your mind. The superconductor LK99, I'm not going to spend much time at all pretending to know about the science. I've never taken a physics class in my life, so I'm certainly not one to pretend there. But you've got some extraordinarily high movements in companies that are perceived to potentially be beneficiaries from this technology. So to me, it's more of a comment on the market broadly that these kind of stocks jumping hundreds of percent on the notion that there might be a breakthrough in this technology. It just tells me the type of landscape we're in, right? It's a very speculative environment. There's a lot of euphoria. It's a very high risk-taking appetite. People piling into these speculative names just because they think other people are going to pay more for it. It's they have no idea about the underlying fundamentals. They're just saying, I think other people will buy this as word gets out, so I'm going to buy it now. On the hope that I can sell it to somebody else. They're trading sardines, I think. And the graph shows some of these companies have had massive jumps. Look, again, it could very well be a real technology. It could, just like artificial intelligence is likely going to change things. Perhaps room temperature superconductors do too. But I am skeptical, as I tend to be, when it comes to new technologies and these extraordinary claims. But the market is not a skeptical place right now. So I think that just highlights where we sit. And then last item that I'll mention, because I'm going to just skip over Bank of Japan for now, unless people want to talk about it, was kind of a discussion on this shift between travel. So there's been a kind of shift away from domestic travel toward international travel, which seen really good results from cruise lines. A lot of these kind of discretionary travel companies have had a wonderful year. And to me, my perception is that this is, I don't want to say the last hurrah of revenge spending, but this is kind of a continuation for sure of people overconsumed on goods. And now, given they were unable to consume services for some period of time, they are over consuming on travel and leisure and some of these other services. So I am going to watch closely, right? There's no evidence, at least if you look at, say, Visa as a good proxy for like consumer card activity and overall spend resilience. Visa reported last week, and it was kind of in line. July month to date was in line kind of with the mid-single digit transaction increase that it was seeing year over year for the first kind of half of the year. So you're not really seeing the consumer dissipate domestically just yet, but I continue to have concern around that resiliency of spend as you get kind of these incremental repayments getting switched back on in a few weeks' time here for student loans. So let's see how resilient the consumer is as we come into the holiday, and that'll then prove to me that perhaps the real economy is even more robust than people had thought. But that's all I had prepared for this week. As I said at the onset before kind of anyone joined, probably gonna keep it a little shorter this week. Maybe run for another hour if people want to chit chat enough. Otherwise, perhaps wrap it up at 5 at the top of the hour. But yeah, Joe, I don't know. Are superconductors something you're piling into and FOMOing into?
Rod, you know me, I don't FOMO. I only make calculated decisions based on long-term prospects.
Well, speaking of calculated decisions based on long-term prospects, Tupperware, the venerable maker of food containers, it's our newest meme stock, right? Uh, it had a restructuring after hours yesterday where they've deferred a lot of kind of cash interest payments. They're going to do like payment in kind uh, on some of the debts that they owe. So they got this debt restructuring, which, okay, great. It gives them breathing room. It takes bankruptcy or imminent bankruptcy off the table, right? But it doesn't mean that, Tupperware has magically become a technology company or something. So the stock only closed up 35% today. It was up almost 100% after hours yesterday. And it's just another one of those, crazy situations that we've seen a lot of late that tell me, again, trying to think about where we are in the cycle. And you see all of these stocks that, the moment they announce bankruptcy, they spike, or the moment they're about to enter a bankruptcy filing, like yellow. Obviously this is not the same thing. They're not filing. They've now gotten a restructuring, which equity may end up being preserved, even though I looked at some of the docs. There's obviously some dilution through warrants and the payment in kind. It buys them breathing room, but the creditors, I think, will still end up owning this company, among many others. There was, I think I didn't put it in my notes. Put it in the Discord, but just it was kind of talking about how many companies by year end their interest coverage ratio is going to be down to like 1 times. So there's just going to be a lot more restructuring activity in the coming years. So look, if you're trying to speculate, maybe the play is to find the shittiest company you can that is about to enter bankruptcy and buy up the equity. I don't know. I don't know. It's a very bizarre market. It's a lot of stuff that doesn't strike me as rational behavior. Um, but it's okay. I could be wrong, and that's what makes a market.
I guess we'll see if the apes really use Tupperware for their bananas.
Yeah, so Tupperware was the fourth most touted stock on StockTwits today. It was the seventh most traded stock by retail investors as of this morning. Yeah, incredible. Who would have thunk it? Our our another favorite of our discussion points is Bed Bath and Beyond. The lost corporation's equity is still trading at above $200 million, despite share cancellation coming in about 30 days. Yeah, there's lots of crazy stuff in this market. But yeah, so I'm done with any of the prepared material. I am happy to let anyone kind of chime in, ask any questions, bring up any other topics. Otherwise, yeah, like I said, I want it to be a short week. It's been an exhaustive one for me. So we'll wrap this up sooner rather than later then. Either way. Let me go to the Discord. Again, I have, obviously I can't hear you if you're talking in Discord stages, but if you submit a question via text, I can see it. And yeah, if you want to come up and speak here in spaces, feel free. But what's up? What's up, D-Bone?
What's up, man?
Living the dream, buddy.
I can tell. I can tell. So what did O'Hare say? The market looks like it's exhausted, looks like it's topping out. We had a big midday reversal.
Oh, I didn't catch that conversation.
Well, the Bears at the beginning of the day, I mean, the Bulls, they were convinced, we were back off to the rally, back off to the races. And then midday, kind of end of day, everything just kind of reversed entirely.
It's it was interesting the factor moves. So large growth kind of was dragged down by Apple as the biggest loser. Small cap value actually was green on the day though, and value broadly was much better performer than growth today. So if you're a curmudgeon like me, it's the stuff you like to see. Maybe the market can get a sense of maybe it can come off of this coke high it's been on.
So what has this been? Has this been a big ass short squeeze? You think? Like,
There's been a lot of short squeezing. There's been so I don't hyper obsess over it, but I've seen notes out of some of the prime brokers about like some extraordinary levels of short covering because you've got a lot of hedge fund degrossing. So if they're short, right, then they're going to buy to close. If they're long, they're selling. So you've had a good amount of that. I've heard a few people discuss over the past few weeks, which is part of the reason why you've had a lot of these short squeezes. I think retail sentiment is still pretty freaking high. Depending on which kind of sentiment survey you look at, most of them are still extremely elevated. Maybe they're off of the highs, but still very high. So, it's VIX woke up again. Somebody had asked me earlier in the week if I thought VIX would close higher when it had spiked earlier in the week, and I did not think it would, but it did close a bit higher. So it closed above 17 today. If you look at the sectors, it's kind of a curious one where you have utilities and technology as the biggest laggards. Typically utilities are a flight to safety. So it's a little curious to me to see staples and utilities down there with technology as the biggest laggards on the day. So that's not indicative.
I think the utility thing has something to do with interest rates. Maybe.
Yeah, I mean, utilities are more interest rate sensitive, but seeing staples down again is not what you would expect to see if it's kind of a flight to safety. So I don't know. I don't really care much about the short-term moves, as everyone knows. I don't trade short-term, but the market is still very richly valued, and it will be interesting to see if we get more companies kind of warning about what they see in the back half or the lack of visibility to the back half. We're obviously most of the way through earnings season by now, so we'll probably get a little bit of a lull as we get through the balance of the summer and people come back from their summer vacations. My thinking would be that the path of least resistance is down toward more normal valuation levels, but there's no reason why things can't keep going higher.
Yeah, I wouldn't want to buy Apple right here. Everybody's like Apple's the safest play, best thing to own, but you're buying.
Nope, not when you're paying a 3.5 PEG. It's just you're just way overpaying for the lack of growth.
Yeah, but they think that it's safe. They just see it as like, oh, look at how this thing's done. I think really a lot of people prices just confirmed, given a lot of people that don't think that they have confirmation bias, it's given them a ton of confirmation bias. And I would not hang my hat on Apple right here.
I'm short Apple common and long puts, which was nice today. But look, again, a comment on the valuation has nothing to say with the business. It is one of the best businesses in the world. I don't disagree with Mr. Buffett on that notion, but I kind of see it being worth closer to $100. It deserves a premium, so maybe 120, 130, which would still be
the company is not in
$2.
question. What's in question is irrational human behavior. It's not the company that's in question.
But you made a point at the onset that was it rates driven, but rates dropped across the curve today from what I can see. The 2-year had a pretty big decline today. So did the 5 and the 10. So those rates actually fell, which again, the fact that utilities fell so much today, and Giro, I would love to hear if you had thoughts kind of on that. It's just not what one would expect to see with rates dropping for the interest rate sensitive utilities and kind of the flight to safety staples both being among the biggest decliner sectors. It's a weird day, I guess, is what I'm saying, glancing at those things in conjunction. What do you think, Jiro?
Okay, but hi there. Sorry, I keep continue your last sentence. Could you repeat, Rod?
Yeah, I was saying it's a little weird to see rates decline, and in an interest rate sensitive sector like utilities being among the worst performing sectors, and a typical kind of risk off sector of staples also being among the worst performers alongside technology today.
Yeah. Because if you, I think it's because today's NFP prints had a message for both, basically. So if you're super bullish, if you're in the soft landing camp, then you felt very confirmed, right? And because you would say, okay, NFP is coming down, right? Last month was 200,000. This month, I think a little bit above 180 or around 180,000. So if you're in the soft landing camp, then you think, okay, it is working. But if you're in the hard landing camp, then you might also think, okay, everything is deteriorating a lot, right? So although you said utilities is a very interest rate sensitive sector, right? You said.
I did. Am I wrong? I could be.
No, of course, but maybe it's it has more to do with because there are market participants who think, okay, first of all, the front end is coming down because it was not only because of NFP, but also because we had Fed speakers today, Bostic and Goolsbee, and they both, without saying it literally, but they basically it implies that the top in the policy rate is in, right? So they will not hike one more time. I mean, that's if you read between the lines, that's what they said today.
Yep, and that's what's priced.
Yeah. So I believe the move down in rate was not only NFP but also because of Fed speak. And what I also wanted to say, exactly. So the soft landing guys felt confirmed, but also the hard landing guys felt confirmed today, right? Because they would also think, okay, so recession is more probable because the labor market is deteriorating. At least the NFP edit numbers. I mean, not when you look at unemployment rate. It actually went down slightly.
Yep.
And also average hourly earnings is actually going up again. Although I hate this indicator, it's a terrible indicator. I will not go into the details.
Well, I think Jiro, it's probably because I mean you've heard me say it, and I heard Monative say it, who isn't with us right now, but this notion that you're just going to have different sectors, different industries within the economy, experiencing recession. I feel like the word recession is like thought of as like the worst thing in the world, perhaps because of when people think recession, they think, oh my God, 2008. And all that recession means is that it's a decline in activity from the level it was at. And like it's obvious that there are some spaces in the economy that have already undergone recession or are perhaps through most of it. Like freight is showing some green shoots. Perhaps it's through the worst of it. I have on my screen the PMI from this month, and if you actually look at what the respondents are saying, which I know some people don't like it, because it's just asking purchasing managers what they think, but most of them are saying demand is softening. We are getting fewer orders, and while it is entirely possible that the rate of decline for manufacturing, the composite PMI has bottomed out, which I think is actually true. I think it has bottomed out. It's still declining, and it's some pockets, right? The IRA influenced pockets, I think, are going to continue outperforming. I follow transport and the trucks on the vocational side, your construction equipment, your kind of the straight trucks that are used for that, are still booming. So it's just, I guess what I'm saying is, like, people generally like to draw very broad pictures, and I think it's very not that case, and that we'll probably continue to have little rolling, soft spots in the economy, even though I think it's more likely that broadly the softer landing, or we don't get a decline into a horrible, nasty recession is my expectation at this point.
Yeah, I mean, I was also in the soft landing camp, and I still am somewhat, but not so convinced anymore. And let me say why. Uh, if we only look at the U.S. economy in isolation, it looks great, right?
Yeah.
But the problem is we are a global economy still. If we look at Germany, right? I mean, that looks horrible. I mean, and that's the engine of Europe, right? I mean, supposedly, manufacturing is looking terrible. Outlook looking terrible. If you look to the UK, actually, there was also a recent article in the Financial Times. So a lot of consumers in the UK, they are actually withdrawing a lot of money in order to finance. How do you say? But when I say withdrawing money, I mean withdrawing from their from their investment account. I guess similar things also happen in the US, right? Where you cannot afford the bills, so you just how do you say? You just You just have to shrink your investment portfolio, basically, right? And then what is the biggest sign for me is actually emerging markets, and especially Latin America. They were super early starting hiking rates because they are very used to inflation, right? So I believe that's why they knew when they had to start hiking, whereas the Fed, ECB, and also the Bank of England waited for too long. They already starting to cut rates, especially Chile, and next one will be Brazil, right? And it's not because it's like they're planning, how do you say, because everything is going smooth, and they are preparing for soft landing. It is because growth is looking bad, so they actually cut by more than the market expected. So when I look outside of the US, plus everybody's quoting the GDP now from the Atlanta Fed, right? And that it's starting. It started at 3.5%, and now it's increasing to 3.9. That's the last update. But it is literally based on nothing, because when you because as you actually highlighted, Rod, right, that there is no team actually involved. It's
Right.
a totally automated algorithm, right? So basically what's happening is, so Q2 is done, right? A day before the Q2 GDP print, they revealed their final estimate, right? And then and they were spot on, right, with 2.4%. And then what's happening, I believe, is they use all the, how do you say, all the parameters that they had from last month, so basically from June, and then they extrapolate these numbers over the next 3 months. And that's why I believe the initial print, or the initial estimate, was 3.5 or 3.4%, right? But there was no data in yet, right? There was no data. How do you say it? There was no data input yet, so it was just an interpolation or an auto regression or something. And the only data print that they released that changes from 3.5 to 3.9 was ISM manufacturing and some construction something, right? So it's only one data point. Whereas when I look at the Bloomberg nowcast, there are way more inputs so far, and currently it's trending at 0.6%, which makes more sense to me. Yeah, so because also it is in line with what you see in how do you say, on the equity market, the stock market, right? everybody's talking about earnings beats and whatever, and I know 74% or 80% beat their estimates. But when you look at absolute growth,
Exactly.
uh,
Yeah. How much of those
it's
quote unquote beats are because management, yeah, made sure the analysts nudged their forecasts down throughout the quarter?
yeah, it's a proper recession, right? It's a dramatic, especially an earnings recession, right? Like revenues are still flat, I would say, flattish, but earnings are terrible. But I also think, Rod, that might be because the problem with quarterly earnings is that you always compare with what do you say, with last year
Right.
earnings, because you have to account for seasonality, I guess, because most companies probably make less money during I don't know, maybe during September, because so many people are on holidays. I mean, apart from the touristy or the leisure companies, right? Um, so okay, it makes sense to compare it with last year, right? And so I thought, is the equity market still so euphoric? Because year over year, earnings are down almost minus 8%, right? So if you compare Q2 of this year so far with Q2 of last year, earnings are down 8%. Maybe that's a good sign. Maybe it's not. I don't know. I mean, to me, it sounds terrible. But maybe Q2 of last year was such a cracker year. It was such an amazing outlier, positive year. It was reopening and whatnot, right? So maybe the minus 8% that we have now is some kind of a normalization, and it's kind of good news, right? So I don't want to be too pessimistic. I'm just highlighting that in absolute terms, the rate of change, everything is trending down, and I know, for instance, Bill is always very optimistic, and I appreciate Bill very much. But I disagree with him with respect to GDP. I don't believe for 1 second that Q3 is trending towards 3.9 or 4%. It doesn't make any sense that it would go up, even in the most positive scenario. I would say that it it should at least I mean, at least the direction of travel should be down, and that's also what the Fed wants anyway, right? I mean, imagine if it went down to 3.9%, then we would have a reacceleration of inflation, and then we would be very far away from the 2% target. Then we would be trending, I don't know, with 4% GDP growth. We are currently, headline CPI is trending towards 3%, let's say, on average. I mean, it will trend up now. The By end of August, we might have 3.8, 3.9%, so a reacceleration, but it's just a short-term reacceleration. Um, uh, but actually, I would say we are probably trending towards 3%. If we really had GDP growth that high, then we are definitely trending towards 4.5% inflation, right? So that's not what the
And it's
Fed
hard
wants
to
at all.
ignore how much of that growth is being fueled by these extreme deficits in the context of full employment,
Yes.
which is rather extraordinary and quite worrisome if you're already running the spigot full open or awfully open. And if you find yourself in a situation where historically you want to not have as much fiscal spending when you're at full employment, right? You want to leave yourself leeway so that when things cool off, you can use the fiscal impulse. But yeah. So, anyways, stock pursuit. You came up. I want you to get a word in before we keep going on this macro diatribe.
Hey, yeah, how you doing?
Doing good.
Yeah, I just had I had some comments on, you were talking about stocks earlier. Like, I know you're talking about the macro now, but just real quick, I had a couple of things I'm looking at with merger arb spreads. I'm still looking at the iRobot Amazon deal. That one's still good to go, and that one's been there was a huge spread on that one in the past, and that one's shareholder approved. So there's a spread there still with the iRobot and Amazon, and the next one is is I
It's a
just found out
massive
about it today.
spread. I mean, the deal is at what price? Because they're at under 40. Isn't the deal at 60?
61 a
Yeah.
share. Yeah, it's 61 a share, and I mean it trades options too. So like there's calls. Like I mean maybe it'll get even cheaper, but we'll see. The other one I was looking at was
Oh, I didn't see that
I
they
just found out
cut the
about.
price of the deal last week from 61 to
Oh, really?
51.75.
Oh yeah, 51. Okay, yeah, yeah, yeah. They cut it. Yeah, but it's still a spread though, right? I mean, was it 30 something
Right. Yeah,
now?
you're still talking about a 25-ish% spread. Yeah.
Yeah, and the other one I was looking at, I just found out about today was Spirit Airlines. The ticker SAVE, SAVE. They're getting bought out, um, and there's like huge spread on that one. I think it's like 50% or something. But they were trying to get it blocked. The regulators were trying to block
Yeah.
it, but I think they were gonna do some finagling to get it to work out. So it looks like that one has potential too. The Spirit Airlines, and that one's like the buyout deal was like 3.8 billion, and it's like the market cap now is like 146 or something. So that's a potential too. But I know you like to look at like a lot of fundamental stuff like that. So do you know of any other spreads right now in the merger space? Or I know the Activision was the big one before.
Yeah, that was the one that came to my mind, which it's pretty slim now. I saw somebody, was it Bill Gross who was talking about it?
I don't know.
That's right.
But I
Earlier in
just
the
saw
year,
some potential there. Like as far as I know, the Spirit Airlines one was approved too, shareholder approved. But I just found out about it today, so I was just kind of doing some research on it.
oh, good stuff. Appreciate you sharing. I have not been staying super close to merger RBOPs, but I thought I saw Bill Gross talking about it. Somebody was talking about there still being something left in the tank on that one.
Yeah, and I had some comments on the overall market
Yeah,
too.
go for it.
Like I kind of it's really hard to predict the macro. Like macro is really hard to predict. And usually since the market's so forward looking, it's like back in 2009, all the economic data in 2009 was terrible. Like in first quarter of 2009, market data was all the economic data was horrible. Everybody's like, why is the market going up? So it's really hard like to predict. But the way I kind of look at it is, like historically, if you look at the historic returns, average year returns, the the market very rarely is up over 30% a year. Like some of the like right now, as far as from what I heard, we're in the top 10. It's one of the best years ever. One of the top 10 years for market returns. So I think 1954 had a 46% return. In 1954, that was something that was a totally different economy then, and the I don't see the second half having a really strong bull case with just based on the probabilities of what the market's done in the past. I mean, what would the catalyst be for that? It wouldn't be profits because we've seen like Microsoft and a lot of these big tech companies are the AI spending has kind of been it's not really paying off immediately. So they're kind of just like building up for that. So I don't know what would be the catalyst. Like it
I
seems
mean,
like
you
there's
would
more
need there
probability
to
of something bad.
be, because right now, to the point that we were talking about earlier, right? The second quarter earnings year over year were down. Um, you've got a lot of earnings growth, at least at the S&P 500 level, baked into analyst forecasts from the fourth quarter through 24 and 25. So you would need there to be incremental growth. I would think you would need there to be incremental growth beyond what's penciled in, whether that's fueled by more productivity through AI implementations or ongoing digitization, post COVID. I don't really buy into that. I guess that's what I would think for there to be upside to the estimates. I don't see the upside likely coming from the top line revenue. I would think they would come from cost takeouts for most of those companies. But I mean, like broadly, S&P 500, the full year 24 estimate is still for a 12.5% EPS growth in 24 over 23. And then for 25, it's 12%. And I go back and I look at the last decade and I see that earnings have never grown at that rate. 2018 doesn't count because you had the tax cut impact. And 21, yeah, of course, it was way higher than 20 because you have the distortion from the COVID impact in 20. So like from 2012 through 2022, otherwise you don't have that sort of earnings growth. So what's assumed is that you have extraordinarily high earnings growth. And yeah, I'm with you. You would need to see it come in even higher than expectations, which I don't see ways other than like digitization and other technology implementations, which maybe it's possible. It seems awfully optimistic to me, though. Jiro, I don't know. You want to add anything to that?
Yeah, sorry. Because I couldn't find the Twitter icon because now it's an X.
It was funny. I
Okay.
saw I saw
Yeah.
that like 80% of the iOS feedback have been 1-star reviews since he did that change, and a lot of them, I literally know people who are not regular users but are deleting the app because they don't want what looks like a porn icon on their phone. But anyway.
No, makes sense. Yeah, looking at earnings estimates. So, because like I said, that Q2 might also be so terrible, the -8% earnings growth versus last year, because of this base effect, right? That last year was a cracker year. But that might also reverse actually in Q4, right? So even if we have a very normal earnings season, basically, right? So Q4 will have positive growth, because then you don't compare with crazy earnings anymore, because then you compare with a I won't say shittier year, but a more normal year. Let's put it this way. So yeah. So I'm very open to the idea, right? That when I share this kind of charts and graphs, right, that show that how do you say it, earnings are declining sharply, that maybe it's not such a big deal, because we are comparing a normal year versus a crazily good year. With respect to growth in absolute terms, what you guys discussed, yeah, I mean, in the end, it depends. It depends also on exactly on the macro environment, right? So if that's true what you said, Rod, that companies are now trying to defend their margins, right? Then of course they will start cutting costs, and the easiest way is probably employees, or not the easiest way. It's the most expensive part of the costs are usually employees. In order to defend their margins. Yeah, and that of course, and the problem is, okay, and that would defend their margins, but this would then finally increase unemployment and might bring us the recession that many people are actually waiting for. I mean, also one of the reasons why there might be a lot of cuts approaching is also because real wages, like everybody is, and not everybody. When I say everybody, I'm just saying a lot of Twitter people. I don't know. They are saying, yeah. Real wage growth, it's amazing. And it is, of course, we all want to earn more. But the problem is that for a company, wage growth is very sticky. Um, and if inflation, how do you say, especially wage inflation is higher than what they can pass on to customers via increasing the prices, basically, how do you say, of the product, then it is actually an increased cost to them, right? So companies are seeing real wage growth, how do you say, positive real wage growth, not as positively as we see real real wage growth. So this effect alone will also more more likely than not also trigger layoffs. And yeah, I mean, I'm not saying that that
There's
unemployment
been a
rate.
lot of
What is it now?
literature kind of discussing how reluctant companies have been to really go to that final decision of laying off labor, given how they've kind of got it ingrained in their mind how difficult it is to attract labor. I've seen a lot of literature around that, and I do wonder, do we get to that point where it's like companies do like to follow the leader. So if you do start to see, because we obviously on the tech side had a big uptick in layoffs, we've kind of gotten through all of that. But you're right, like at the broader economy level in many sectors, there have not yet been upticks in layoffs yet. And usually, though, when that gets started, it's hard to kind of keep it in control. But there does seem to be this inclination among employers not to
Mhm.
let people go because of they have that in their minds of how hard it is to get them back if things turn on a dime.
Yeah, yeah. So I agree. Like at the end of a cycle, it is true that companies are very reluctant because um, because with unemployment rate at 3.4% or 3.5%, it's very tough to find qualified employees, right? So even if you get margin compression, you want to keep them, and then of course you start with decreasing the hours. What you actually could see in the average hourly earnings today, you could also see that average hours actually decreased a little bit. So I mean, it might be the start of a trend. It might just be a pickup in something, right? So I don't want to put too much weight on this, but it is actually fairly normal that towards the end of a cycle, yes, companies try to hold on to the people that they just hired, but as soon as it eats too much into their margins, they will start laying off people.
Yep. Hey, Chris. Good afternoon.
Good afternoon.
Um, just I'm making an executive decision. I'm gonna close it out at 5:30. It's 5:02. Just FYI, folks. But Chris, do you want to chime in on the discussion or take us in a different direction?
Yeah, sorry, I just got in here. Have you guys discussed Apple already?
We talked about it a little bit at the beginning, but I don't think many people were in here when I went through it up front. So if you wanted to chime in, feel free.
Yeah, yeah. Yeah, I think it's interesting how there are these very large mega cap companies and they're in a lot of different industries and they're taking shareholder money and they're reinvesting it. But um but it's interesting, like at Apple, for example, they're reinvesting a lot of money and Amazon as well in the media business, right? And like right now, like the media business is not so good. Um, right? You have to spend billions of dollars to retain your customers, right, on media, and you're selling these subscriptions for just a few dollars a month. And I think like Amazon, they're invested in like quantum computing and some things that probably most employees at Amazon don't really understand. And it's even to the experts in the industry, quantum computing, like it's not really clear when or if that investment will pay off. So I don't know. What are your thoughts? Like, do you think like these guys are really like great stewards of capital, or do you think like they're just kind of using their gut? Or I mean,
for Apple, it would be hard to argue that they haven't been good allocators of capital broadly. I mean, you're right. There's certainly some stuff they're spending on that I'm sure is suboptimal, like all of the mega caps. But I mean, I think we've had this conversation. I personally don't think it's prudent for them to be repurchasing shares at such a high valuation where it's actually, their earnings yield is below that of risk-free treasuries. Like, to me, they should consider special dividend or just using dividend as the means of returning capital to shareholders versus repos at kind of these levels. But it's hard to argue too much with Apple. But let me ask you this, Chris, because I think you're one of the only people with a meaningful physics background in the room. What do you think about the superconductor news?
Look, I mean, I don't really, I'm on like an expert on superconductors. Like, I just have a bachelor's in physics. I studied condensed matter, so it's kind of related, but the stuff is really complicated, and it looks like a promising material. I think there was a group in China that verified zero resistance at like 110 Kelvin, which is like minus
Which is really cold.
160. But it's important, right? Because liquid nitrogen, right, is cool enough to keep it at that temperature, and liquid nitrogen is relatively cheap to manufacture. Usually superconductors have to be cooled with like liquid helium, which is a lot more expensive, costs millions of dollars, right, for these labs to do these experiments, especially like quantum computing experiments, right, where like you have to keep the temperature down to like millikelvins. But yeah, I think it's promising. I think the team that originally came out with a paper, they made some claims. I don't know if they're necessarily true. And it seems kind of fishy, right? Because they don't want to provide the sample, right, to other research teams to verify. And they said something along the lines of like they're moving on to some other research, which is kind of surprising because this seems to be like a really important, thing. You'd want to verify it, right? You want to be sure that you were right. They seem very confident, but I haven't seen any real proof that we have superconductivity at room temperature. I think that's a very, very strong claim, and I haven't seen proof of that. But even at 110 Kelvin for a new material, for a first try, basically, would be a very, very good result, and it would, bring the TC, right, which is the threshold temperature for superconductivity up, right, to levels that are, still well below freezing, but higher and higher. And as we learn more about like how these, because we still don't really have a theory for how these high TC superconductors work, right? So if we have a better theory for it, we can, start, engineering more materials that, just even improve it even more. So I would say it's more of an incremental improvement.
So before, Sick, I know your hand's up. Before you chime in, Chris, are you piling into all of the superconductor speculative stocks? We talked about that
I
earlier.
am not. I have not touched them.
I pointed out earlier kind of that I view that as a little bit of a proxy for kind of the still very rich risk-taking appetite in the markets broadly that, like you said, it's perhaps unlikely that the room temp superconductivity is a real thing, but just that the impulse is to immediately kind of pile capital in to everything as a speculation still seems like kind of where the market is at, and maybe indicates where we are in the cycle. But Sick, please go ahead, and then Jiro.
Hey, afternoon, guys. Yeah, I like Chris is pretty much on point with like everything that he said. Like I also asked my parents, like they're really big consumers of Korean media. Even Korean media saying that like this is highly skeptical, and it's just probably not worth going any further at the moment for now. And if something about Koreans that you got to understand is they're highly nationalistic. So if this was like Nobel level stuff, then they would be completely on it, like, oh yes, we're looking for another Nobel Prize, blah blah blah. But even Korean media is like very I guess like reserved on like what's been coming out recently. So or at least that's what my parents have been telling me. I don't know what Jiro's parent or mom might say also. I'm not sure if she follows around Korean media, so just kind of curious on that.
I of course like a lot of Korean dramas and news and everything. No, I mean, with Koreans, there was a case, and Psych probably also remembers there was a scientist in Korea 10 years ago who said
Oh,
that
the
he could make the
cloning.
first dog or something like this, or sheep, right?
It was a dog, I
A
think, and
dog.
then like he got like I mean like they did end up making some sort of technique later on down the line, and Korea is cloning dogs now, but it wasn't as crazy as it. Yeah, like it was a scandal. I think that's the reason
Yeah.
why.
Exactly. No, I'm not saying that this is a scam, right? But I could imagine that there is a lot of exaggeration involved, for sure. Maybe a question for you, Rod. Like, what would be a pure superconductor play? Because with AI, a pure play, people say is NVIDIA, right? So what is a pure superconductor play?
I am the wrong one to ask about that, but I've seen a few people who I follow on Twitter point out BRKR as a potential play on it. But again, I've literally
Uh,
done no work at all on any of these companies.
there's a
I would
it's American Superconductor. It's AMCR.
think that's a
Cool.
scam
Thank you.
company. I don't think they actually work with superconductors really. I think they just change their name every few, years for the current thing.
How
Okay, yeah. Well, I mean that one's like but that was the play that everybody went into. But the one I've been looking at is Rigetti, RGTI, and
That's a quantum
Palantir.
computing stock.
Yeah, yeah. Palantir invested in them. Um, Palantir had a partnership with them like a year ago or two. So that one seems legit. Like I'm kind of trying to figure it out. They have a.
Rigetti won't last 2 years, in my opinion.
I mean,
Um,
if you look at the growth rates, I mean, it's pretty good, right?
yeah, but their technology is just not good. I have friends who like work in quantum computing. I have a friend at NIST, and they're like the laughing stock of the quantum computing industry. Um, it's they have like 2 years worth of cash, and they'll burn through that. But yeah, I wouldn't count on Rigetti really. It's gone up like I think 6 to 8x from the lows this year, just in a few months. Um, so it's been a very big boon for speculators, but a lot of this quantum computing stuff, it won't produce returns, right, for another maybe 30 years for a lot of these companies. And Rigetti is not one of the top ones. Like IonQ, maybe they have that deal with Amazon and maybe for research right purposes and institutions, but like Rigetti is kind of like I don't know. That's just my take, but you're free to disagree with me.
Yeah, sure. Well, yeah, I had yeah, I appreciate your opinion. Yeah, I had from the research I did, it seems that they say they have like a quantum computer hooked up to the cloud, and like that's what they're working on, and apparently maybe it's already in the works. Like that's it's kind of what their business model is. Apparently, it seems. But I don't know. Like I'm not an expert on quantum computers by any means, but that
Yeah,
one
I think
seemed yeah.
the question you really want to ask is what does it actually do, right? So like quantum computing, the number one, use for it basically is Shor's algorithm, which is to crack RSA, right? Crack encryption. And we're very far away from that,
is that
right? We
bearish
have systems
crypto?
with it is actually. I would agree, right? So if your thesis for crypto is to buy and hodl forever, right, for the next 30 years, right? We might have a quantum computer in 30 years, right? That, and Bitcoin, for example, is the least secure crypto, right? It was created first, right? So their encryption is not, particularly great. So I wouldn't really, I would be scared, right, if I was holding crypto for that long of a time and I was bullish on quantum computing. But yeah, like I was gonna say, to stock pursuit. Yeah, these are, very, very long-term investments. And I don't see a good reason for these kinds of stocks to be on the public market. These are kind of things like maybe Amazon, they have a bunch of cash. They want to, fund some of these things, right? But for, everyday retail investors, right, that they don't really know what this stuff is. They don't really know what any of it means. I don't think it's a very good idea, right, to have these, in public markets. I mean, you may disagree with me, but yeah, that's just my opinion from some of the people in the industry I've talked to.
The question to Chris, maybe. Uh, uh, because I'm on Bloomberg right now and I'm trying to find some pure plays. Yeah, there seem to be a couple of Korean companies, but nobody's certain actually. But what about, because you said that okay, probably it's not working at room temperatures. If we maybe find companies that can produce these materials or whatever that are needed in order to bring things down to room temperature, what do you think about this? Maybe a indirect play on superconductors.
Yeah, I'd agree. I think there are already materials that superconduct at above the liquid nitrogen temperature, right? So, we have cuprates, right? It's a family of, superconductors, right? Like one famous example is yttrium barium copper oxide. Um and yeah, they're all copper based superconductors, and they are they've been around for a while. And yeah, they superconduct. I think they're companies that are producing these. um I think for fusion, right, we need superconductors to produce a very strong magnetic field to confine the plasma and to get fusion to ignite. um but um but yeah, I think rare earths as well. I mean, it's a much safer play, right? Because we need rare earths anyways. But like, if you want to make superconductors, right, you need these really heavy elements that you know y- they're not very plentiful. So
Buy the big industrial gas makers. Time to buy Air Liquide and Linde. I don't know. I'm just goofing.
yeah, I mean, I don't know how long this hype will last with superconductors, but yeah, I think the lead appetite, I think it's probably here to stay. I think, there was a Chinese group that suggested replacing the copper atoms with gold, that would, give a better performance. So, I think it's very worthy of study, and I'm really excited, honestly, as somebody with a physics background, um, to keep tab on this. But yeah, for investors, this gets kind of hard, right? Because this is the very, early stage sort of thing, right? Um, it's going to be a while, I think, until we can get room temperature, superconductors. Um, but even observing, something like diamagnetism at room temperature would be cool, with these materials.
Good stuff, guys. Appreciate the conversation because you guys definitely know more about this than I do. 15-minute-ish warning. If you want to talk, John, or ask any other questions, feel free. Or take us in a different direction. Or if people want to talk about superconductors more, welcome to.
So Rod, is there an announcement for the Playboy earnings, or do we still
Yep,
not know
came out
yet?
yesterday after hours, so it'll be Wednesday. So the 9th,
Wednesday.
we will, like we've done, I think, for the last 3 or 4 quarters, we'll host spaces at 4:45 kind of recap the results, and then we'll play the call, whatever that is going to be. They they indicated that the format would be a little bit different this time, which I read as they don't want anyone to ask questions that they don't want to have to answer. They said, quote, "This format is slightly different than in prior quarters and allows the webcast to be conversational and more focused on top questions than on prepared remarks." So, yeah, they'll do the analyst Q&A, but I am, you know how I feel about Mr. Cohn. I'll leave it at that. I am looking forward to the results coming out and hearing about the ongoing restructuring and asset sales, as well as the creator platform. And as I noted last week, whatever week it was, I intend on writing the board after this earnings if there's not been a material change in direction, formalizing my discontent with Mr. Cohn and calling on his firing.
Yeah, I would be interested in hearing the update on the joint venture. They mentioned it in the beginning of the year, right? That they announced it, but I'm kind of curious how that's moving along in financial data.
Yep. So we'll get that Wednesday after the close. I mean, the expectation, at least from sell side, is 3 million EBITDA loss in the quarter, and it's like it's less. The current financial results are less relevant to me. I mean, understanding what's going on in China is, like you said, what is this JV's kind of operating results looking like? I'm not as concerned about whether they lose money or not in the current quarter. I'm more concerned about what are they seeing as kind of net of the restructuring costs, which they're going to have to eat more of in this quarter. Like, what is the run rate kind of profitability for the company looking like? Have they effectuated any of the artwork asset sales? They've obviously had Lovers listed for some time, as well as Honey Birdette for sale. There was a swimwear company in Australia that sold this past week, not at favorable terms. It's, I guess, a cousin to the lingerie business. But I tend to think from my conversations that the Lovers sale could be announced as soon as Wednesday.
Yeah, I guess there was that Ackman post yesterday, right, about the 30-year treasuries. He shorted a bunch, but it seemed like they've recovered up to now. But Jero, do you have any opinion on where you think the long end of the curve will go? Like, do you think that it'll just revert back to where it was, or?
Yeah. No, I actually even understand the reasoning behind what Ackman is saying, right? Like, he's saying basically inflation. I mean, there are a lot of assumptions, right? So you have the assumption inflation will not go down to 2%, but to 3%. Then Jerome Powell once said that he sees the neutral rates. So basically, the neutral rate is when the Fed is neither restrictive nor are they, what is it called, supportive of the economy, right? So he sees the neutral rate 0.5% above inflation. So that would that would get us to 3.5%, right? And then he also said, but I think that's what Ackman said, because Powell said something about that. He sees the term premium, right? So the 10-year should be 1.5% above the policy rate. above the 1 year rate, basically. So that would get us the 10-year would get us then to 5%, whereas I think Ackman played around with plus 2% to get to the 30-year. So that's why he got to this 5.5% number. I think, I mean, there are a couple of reasons, like, and I have a little bit of sympathy towards it, because, of course, if Japan, the biggest owner of all treasuries, if it gets more attractive to invest in their own bonds, in the Japanese bonds, basically, because you have to know that if you are a Japanese insurance or a pension fund, then I mean, if you ask me, I would, if I was a Japanese insurance company, then I would invest unhedged into into U.S. Treasuries, right? So if U.S. Treasuries are offering me 5 or 5.5% even, right, then I'm willing to take the FX risk, the foreign exchange risk, right? So if it moves within this 5%, then I would still be positive, right? Compared to being actually negative or flat if you invest in Japanese bonds. But because of regulatory reasons, they have to hedge their exposure. And the problem with hedging is if you currency hedge, then the cost is basically the difference of the of the interest rates. So in the US you have 5.5%. In Japan you have 0. So the hedge already costs you minus 5.5%. So if you then invest in US Treasuries, then usually it's even a negative return, or it is not unlikely that you will have a negative return. But now what they saw was that because yield curve control was the band was raised from 0.5 to 1%. So technically, the 10-year government bond yield can go up to 1%. So this is very attractive to them now, right? Because they can have zero currency risk and get 1% on a 10-year rather than to invest currency hedged into the U.S. Treasury market. So I understand that would put some upward pressure towards U.S. yields. But on the other hand, I also see that the U.S. Treasury, and they are already doing it somewhat, right? Like when they refilled the TGA, they only issued bills, in order to have liquidity neutral effect. And so, although they would never call it, the U.S. Treasury and the Fed, they are already doing some kind of yield curve control. Yeah, so I actually strongly believe that, weirdly, that actually the Fed will not let the 10-year or the 30-year in Bill Ackman's case go up to 5.5%. I think they might also start with some kind of intervening actions, because in the end, also the long end is also dependent on the short end, right? So we because I told Rod before that that it seems like that the peak rate is in, right, the 5.5%, because today we had Fed speakers Bostic and Goolsbee, who actually confirmed that they see that rates are very restrictive and blah blah. I mean, there was some wording I forgot already, but it really sounded like that they don't want to hike one more time. And they also said that NFP is also proof that it is working. Blah blah. Although NFP was actually a very contradictory print today. So, but I believe that they are already communicating to the market that this was the last hike. So that's also why I think that the upsides on the 10-year and 30-year, like if the short rate is not increasing at all anymore, and only because Japanese investors are kind of divesting from the US market, Yeah, and I also understand the fiscal argument, right? That because of the fiscal deficit, more treasuries have to be issued. Yeah, I mean it makes sense, but there are actually even studies. I mean, it doesn't have to do with the 10-year, but let's take, for instance, the how do you say, the 1-year treasury yield. Yeah, there are actually studies that if you increase the issuance of bills, then usually the yield curve steepens, meaning that actually the 1-year drops, which is very unintuitive, because if you have the same demand and you increase the supply, then the yields should go up. But what this study found was that if you increase issuance, that sometimes it increases the demand even more. So in the case of bills, uh, there are more money market funds who are how do you say, who are demanding bills, and this increase of demand is higher than the effect of supply, and that's why yields actually drop. So only because you increase supply, I mean, it's always, the assumption is, if everything stays the same, et ceteris paribus, right, all else equal, yes, that's what would happen. But usually there are also many other moving parts. So only because you increase issuance of 10-year bonds because of the fiscal deficit doesn't automatically mean that yields will go up. I mean, because it's also possible that demand will go up. Also crazy, because there are also many foreign investors, and not only Japanese investors. There are many other investors around the globe, and if the US still looks like the best place in town, and let's look around globally. Because, like I said before, Europe looks a little like a mess when you look at Germany. UK looks like a mess. I think China is also not growing well. So if you are a neutral investor globally, then probably the US still looks the most attractive. So only because supply increases on a 10-year, that doesn't automatically mean that the yields will go up. So that was my very long answer to your short question.
Yeah, I think in terms of sovereign government, it's kind of hard to see any, a whole lot of demand for these bonds. But I remember like what you said back in June, right, when there was the whole like debt ceiling debate, and we weren't sure if they were going to default or not, pay on time, right? And there was a lot of issuance that came right in June after the debt ceiling was resolved. And like you predicted earlier, I remember back in May, like a lot of the reverse repo money just poured into those bills, right? So, um,
Yep, it's correct.
so like, who's to say that like if they issued more bonds or bills that more of that money wouldn't just you know come from there?
Yeah, no, the reverse repo is only, if I'm not mistaken, because I don't want to say anything wrong here, but I believe it's more to do with bills with short-term treasuries. So I'm pretty sure you cannot use the reverse repo when you issue like the 10-year, like longer-term bonds.
Yeah, that's right.
So
Yeah,
that
sorry,
functions a little
but
bit
for like
different.
bills,
Yep.
right?
Yeah, for bills for sure. Yeah, for sure. Um, yeah, I mean, I believe Bill Ackman is wrong here. Very wrong, actually. I mean, I know he was in the headlines, and I read a couple of articles, and like I said, it also makes a couple of things that he says also make sense, right? It is not that he came up with the 5.5% number out of nowhere, right? So there is some, how do you say, there is some reasoning behind that. But we are, I believe we are at the end of the hiking cycle. We are at the end of peak rates across the curve. I mean, at the moment, I think, let me check, the 10-year is at, um,
It was a touch over 4, I thought.
it's a little bit. Oh, look at this! It's at 4. Yesterday it was at 4.2%. Wow, this is a huge move. It's crazy. Yeah, so I don't see a scenario where it goes to 5.5%. No, actually, yes, there is a scenario. If if GDP now is correct and we are trending towards 3.9% growth, uh, and inflation picks up towards 5% again, why not? Then 5.5% is totally possible. But we have to think about, is that a scenario that we think is likely, right? That GDP is really trending, not the double the, how do you say, the average trend, right? Because I don't
Seems
know.
unlikely.
Everything's possible, but I don't think it's likely.
So before we close out, I wanted to chime in. There was a story out this afternoon on yellow. So if you've probably heard me mention it a few times over the last couple of weeks, but Yellow is considering a sale of assets and real estate through a bankruptcy filing, which may come as soon as this weekend, is the reporting. Assets of the trucking company have already piqued the interest of a potential financial bidder. The Chapter 11 process could later transition into a liquidation. So, you know, you've been following the Yellow common stock story. There was a hedge fund out of Boston that acquired a little less than half of the company in like several trading sessions over the last couple of weeks. The, I guess, assumption being that 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 hedge fund also owns shares in XPO, another major less than truckload carrier, and that the terminals and the land that Yellow has on its balance sheet are so understated because you don't mark land up on your balance sheet that in this liquidation they're actually going to be, they're worth more dead than alive, so to speak, because they're going to be able to liquidate these valuable real estate and terminal assets as well as the equipment assets. And they, you know, some are assuming that they can pay off the creditors in full and that there will be cash left over for equity. So it's interesting. The common stocks market cap is around 200 million. And if you look at the options chain, the volatility is extraordinary. You've got, you know, depending on which dates you're looking at, volatility north of 350% on the near dated stuff, at the money. On the call side, it's higher on the, it looks higher on the put side due to the borrow rate kind of being baked into that math on at least what I have on my screen. So that one, it'll be interesting to see what ends up happening. I have not personally participated in any of the trades on that one. I'm somewhat tempted to write some naked calls before the chain goes position close only. But yeah, I might need to do some more work on it over the weekend and get a sense. But if the filing comes out, we'll see. I mean, how crazy markets have been. If the filing comes out over the weekend, who knows if the stock spikes further on Monday. So we'll see what happens with Yellow. But I just wanted to point that out. We might get the filing this weekend on it. But look, it's 5:36. I've had a long week. I'm going to let it wind down now. Joe, I'm going to put the onus on you to let us know about the programming we've got coming up next week.
Yeah, next week, turn into the open mic on Wednesday, hosted on @GMEDD. So we're transitioning that account to be more of a due diligence account than a GameStop account. So research multiple equities. So if you haven't tuned in there, give that account a follow. Don't quite unfollow this one just yet. Keep Wook Capital on your list because we're still hosting the Wook reviews over here. But that'll be on Wednesday, and then you can also tune in here next Friday for the Wook review as well. And yeah, Playboy earnings. We'll be streaming the Playboy earnings. That is on the 9th, I believe. Yep. We'll be streaming the Playboy earnings over on @GMEDD. So soon there will be an advertisement on that account, and then you can hit the sign up button.
Yep. Thanks, Joe. Awesome. Well, thank you, Jiro, Sick, Chris. Really enjoyed the discussion as always, guys. So we'll be back next week with those programs that Joe discussed. I think the following week, I'm probably going to take some vacation days, so just stay tuned. We might move some things around, but I'll communicate that when it happens. So either way, no matter where you are in the world, I hope you have a nice rest of your day and enjoy your weekend and look forward to talking soon. So cheers, everyone.